All right, let's talk about the AI stock market in 2026. Man, it is the ultimate high-stakes game, isn't it? On one hand, you've got this landscape of just incredible opportunity, but on the other, it's filled with hidden traps. So the real question is, how do you navigate this? How do you play to win without getting totally burned? Let's dive in and break it all down. Honestly, this is the one question that I think should be on every investor's mind right now. Are we looking at the biggest opportunity of our lifetime? Or is this the biggest trap? I mean, are we on the edge of the next massive tech leap, or are we just staring down the barrel of another dot-com bust? The thing is, the answer isn't simple. And that tension, that's what's driving this entire crazy market. So to really get a grip on what's happening, you gotta look at the psychology behind it all. There are these powerful, conflicting emotions at play. We're calling it the 2026 AI paradox. You know, a recent Bloomberg analysis just nailed the feeling in the air. They called it a Schrödinger's bubble. And it's perfect, right? The idea is the market exists in two states at the exact same time. It's this huge opportunity, and it's also on the verge of collapse. And which one is real? Well, that depends on when you open the box. It's a paradox that forces every single one of us onto this incredibly thin tightrope. And you can literally feel these two forces pulling the market in opposite directions. On one side, you have this intense FOMO, right? The fear of missing out. I mean, who wants to be that person who sat on the sidelines during the biggest tech revolution since the internet? No one. But then on the other side, there's this deep, nagging anxiety. This feeling that we've seen this movie before, back in 2000, and we're all just waiting for the music to stop. It's these two emotions, FOMO and anxiety, that are creating these wild, volatile swings. Okay, so with all this tension, how do we actually measure it? Is there a way to quantify this feeling? Well, it turns out Wall Street has a tool specifically for this. So let's get into it and decode the market's fear gauge. Let me introduce you to the VIX, the Volatility Index. You've probably heard it called the Fear Index. And yeah, for good reason. What's key here is that it's not looking backwards. It doesn't care about what happened yesterday. It's a forward-looking guess at how much chaos the market thinks is coming over the next 30 days. Think of it like a weather forecast, but for financial storms. And the relationship between the VIX and the stock market? It's pretty simple, actually. Just picture a seesaw. When stocks are going up and everyone's feeling good, the VIX goes down. It's calm. But the moment fear takes over and the market starts to drop, whoosh, the VIX shoots straight up. It's this classic inverse relationship. When stocks fall, fear and the VIX rises. If you look at the actual numbers, it kind of breaks down into three zones. If the VIX is sitting below 15, things are calm. Maybe a little too calm, you could say, complacent. The 15 to 20 range, that's your normal zone. But once that number starts climbing above 20, fear is starting to creep into the driver's seat. That's when investors are buckling up for a rough ride. All right, so if we have this fear gauge, and we can see when fear might be coming, we should be able to protect ourselves, right? There's got to be a way. And there is. That brings us to our hedging toolbox. Think of these as the tools you use to build a financial storm shelter. Now, here are some of the most common tools in that box. You've got things like VIXI, which is an ETF trying to track volatility. You've got inverse ETFs that basically bet against the market. Then there are put options, which are kind of like direct insurance policies. And of course, good old gold. But I want you to look really closely at that estimated annual cost column. This is so important. There is no such thing as free insurance in the market. Every single one of these tools has a cost, and each one is designed for a very specific job. And that leads us to a really important question. Are these tools actually a hedge, or could they be a trap in disguise? To figure this out, let's zoom in on VIXI, because it's one of the most popular and easiest tools for everyday investors to get their hands on. Okay, and here is where so many investors get tripped up. This is a huge misunderstanding. VIXI does not track the VIX index directly. What it does instead is track VIX futures contracts. Now, I know that sounds like a tiny, boring technical detail, but trust me, that one little distinction can be what quietly, slowly drains your entire portfolio. Let me show you how. So here's what's going on under the hood. It all comes down to a market condition called contango. Now, stick with me here. Most of the time, a futures contract for, say, next month costs more than one for this month. So what does VIXY have to do? Every single month, it's forced to sell its cheaper expiring contracts and then turn around and buy the new, more expensive ones. Think about that. It's constantly selling low and buying high. This process creates something called a roll loss, and it's like having a slow, constant leak in the bottom of your portfolio. So just how big is that leak? Get ready for this. Because of that contango effect, the cost of just holding VIXY can be anywhere from 50 to 70% per year. Let that sink in. You could lose more than half your money in a year, even if the stock market goes absolutely nowhere. It's all because of how this product is built. It is a devastating trap for anyone who buys it thinking they can just hold it for the long term. Okay, so if that's what not to do, what is the right way to think about all this? Well, it's time to stop just reacting to fear and start thinking like a professional risk manager. See, professionals, they don't really worry about a little bit of market choppiness. They're focused on something much bigger, called tail risk. We're talking about the rare but extreme, earth-shattering market events. You know, the black swans. And here's the crucial part. Tail risk isn't just about avoiding a crash. It's also about the risk of missing a face-ripping rally to the upside. The pros want to survive the catastrophe, no matter which direction it comes from. And all of this really leads to a major shift in mindset. First, you have to realize you can't eliminate all risk. It's impossible, and trying to would be insanely expensive. The real goal is just to survive the extreme, portfolio-killing events. You have to accept that every single hedge has a direct cost. It's a trade-off. So the goal isn't to have zero losses. The goal is to build a portfolio that gives you the best possible return for the amount of risk you're taking over the long haul. Which brings us to the final and most important question, the one you need to ask yourself. Are you making smart, strategic decisions to prepare your portfolio for a potential storm, truly understanding the costs and the trade-offs involved? Or are you just reacting, making bets on what you think the weather will be tomorrow? Because in a market this volatile, knowing the difference between those two approaches, well, that's everything.